In the final part of Chapter 7, let's wrap up some issues that relate to job costing. One issue is documentation. This is a job cost sheet, and firms use this type of document to keep track of how much materials, labor, and overhead go into various jobs that they do. This could be a physical piece of paper that follows the job around the factory, or it could be a spreadsheet in a computer program, and there would be terminals at each point in the manufacturing process. On the cost sheet, we need to show all of the information so that we can understand the cost of the job. There's got to be a place that indicates who the customer is, what kind of products we are making, and the quantity of those products. In addition, we need to know the job number, and for internal purposes, we want to know when the job was ordered, when the job was finished, and when the job was shipped, so that we can keep track of how quickly we are fulfilling customer demands. We also need an area where we can track direct materials, direct labor, and manufacturing overhead. Altogether, these need to equal the total cost for the job. If we divide the total cost for the job by the number of units of the product that were in the job, that will give us the cost per unit, which is very helpful when we are pricing and marketing various products. In addition, this type of document is very useful for external auditors who need to be able to trace various components of the financial statements to determine where those numbers came from. So, where did the numbers on this job cost sheet come from? Well, the materials cost came from materials requisition forms, and the materials requisition number needs to match a materials amount that's shown on the job cost sheet so that we can see what kind of material was used and how much it costs, and these costs need to match. The job number tells us which job this material was used for, and here we have a record of the materials that were used. Finally, we also need to have some kind of approval for the requisition. Firms have a responsibility to their shareholders to make sure that materials are not misappropriated. So generally, good internal controls require approval for all requisitions. Here is an example of a time ticket. This ticket needs to trace back to a particular job, and it shows how much time this particular employee spent working on this job and computes how much money of this employee's time was assigned to the job. Again, we need approval to make sure that the information on the time ticket is correct. In this chapter, we've been talking about how firms decide how much each job costs. But there are actually 3 methods for coming up with this answer. In actual costing, firms use actual materials and actual labor costs, and they try to use allocation of overhead based on actual overhead costs and actual amounts of the allocation base. The problem with this method is it takes time before the firm can determine what was their total overhead and what was the total amount of the allocation base, either direct labor hours or direct labor dollars or machine hours. Very few firms attempt to use actual costing. What we've seen in this chapter is normal costing, where a firm uses actual materials and labor costs, but they use a predetermined overhead rate to assign the overhead. A third way to answer the question, how much did this job cost, is to use standard costing. In this system, we use basically a predetermined overhead rate to allocate materials and labor and overhead by creating standards for how much of these production costs each type of job should use. And then at the end of the period, we compare the standard costs to actual costs and compute variances. That is the difference between what we expected to be used and how much we expected it to cost versus how much we actually used and how much it actually cost. We will be taking a look at standard costing in another chapter. The last issue in this chapter is ethical issues relating to costing. Human beings are natural game players. That is, if they see a way to manipulate the situation to their advantage, they're likely to do that unless they suspect that they could be caught. One way that managers can manipulate a job cost system is to misstate the stage of completion. In other words, say that a job is either more complete or less complete than it actually is. And human nature being what it is, people tend to want more credit for the work that they've done in this period, probably to achieve a bonus. So we need to be aware that job supervisors may overstate the completion of jobs. Of course, net over a long period of time, you can't keep gaming the system because overstating in one period means you get less credit in the following period. Another issue is charging costs to the wrong jobs. This is a problem because other people use cost data. Managers need this information to market products, to price products, and to determine whether production standards are being met. So we want to try to decrease the chance to make this kind of error. In addition, if a customer has a cost plus contract, there's kind of an incentive for managers to overstate the cost of those contracts because the amount that the firm gets paid is based on the cost of the job. The last issue is misrepresenting the costs of the job. If a firm is using a standard costing system, that means that managers will be rewarded based on achieving certain quantity and price goals. If managers have the opportunity to game those costs and quantities, then they may achieve a bonus that they didn't actually deserve. In addition, this also hides the actual consumption of overhead. It's very important for a firm to understand its own cost structure, and that understanding is based on reliable management accounting information.